What investors need to know is that during periods that have below average returns, it requires a much more diversified and actively managed portfolio, something that financial advisors are trained to provide. Advisors often think that since you can't predict returns in the short term, over the course of a year or two or even a quarter, that it's hard to predict them over the longer term. But since there are fundamental principles that drive those returns over the longer term, advisors can go into periods like the 1980s and 90s, or like the current period, knowing with a high degree of confidence that they're set for periods of below average or above average returns. And with that in mind, they can structure portfolios accordingly. And since today we have above average valuations, we're highly confident that the next decade will be below average and will require advisors to bring a higher level of understanding to their clients about what they do and why they do it, to be able to add the extra return to portfolios and returns. Many advisors, but certainly most clients at this point, are hoping for or expecting that they'll get 8, 10, 12% or more returns per year on average out of the stock market until they retire and into retirement. The reality is we're set for well less than half of that. There's so much more value that can be added in a portfolio, so much extra return that can be gained by implementing some of this more actively managed, diversified, product-driven returns that we talked about today.